Never before has the subject of speculation attracted as much attention as it does today. Behind much of the contemporary financial and economic news, foreign currency crises, stock market bubbles and crashes, derivatives fiascos, and technological innovations, lurks the speculator. In the United States, millions of individual investors trade stocks daily. The success of the American economy in the 1990s has largely been the product of speculative funds flowing into the stock market. This has enabled new companies to be floated and old ones to be merged, and encouraged corporations to invest and investors to spend some of their stock market gains. A great bubble of prosperity has been blown before our eyes, and its stability is naturally a cause for anxious concern. Speculation is a divisive topic. Many politicians, several of them in Asia, warn that the global economy is being held hostage by speculators. In their opinion, the speculator is a parasitical figure, driven by greed and fear, who creates and thrives on financial crises, an egoist and a slave to his passions, who in his euphoric and depressive moods reflects the limited intellectual outlook of the crowd. To them, the wealth of nations depends on caging this wild beast. Others, mainly Western economists, take a radically different line. They argue that speculation is fundamentally a benign force, essential to the proper functioning of the capitalist system. According to this view, the speculator acts as a conduit, enabling new information, whether it be the results of the latest inflation figures or the effects of a hurricane on coffee production, to be fed through into prices. Without the speculator, markets would be full of bottlenecks, and economic crises would be even more common. Furthermore, the inception of new technologies, such as the Internet, is heavily dependent on the activity of stock market speculators. Curb the speculator, argue the economists, and capitalism will lose its vitality.